you're operating in a private format. You're accessing capital with institutions, which I think we would love to hear more about. And then I think you've also started accessing capital in the non-traded REIT format. One, talk to us about the institutional capital and how it aligns with your investment objectives, and then give us a little bit of color on what you're doing on the non-traded REIT side as well.
Sure. And my strategy is not a nuclear submarine strategy, so I'm not worried about that. Let me just maybe take a step back. It's interesting listening to my peers. I feel like a little bit of an outsider since I left the REIT world in 2007. And one of the things, and this is about strategy, one of the reasons we sold our company in 2007 wasn't only because we thought the market was peaking and the values were strong, but it was also a question as to how we thought we could build a company that maximizes enterprise value. And in owning publicly traded REITs, particularly the larger ones, eventually you get to a scale that you're valued more closely to net asset value, and to be able to incrementally grow that net asset value, as whether it's as Owen talked about in terms of selling core assets at big prices and going into value add where you're creating value. That's how you ultimately do it. But that is like moving a big warship around to try to get that done. That's not something that can get done easily. Whereas as we reformed ourselves subsequent to our sale in 2007, as RXR, we decided to finance ourselves using private capital and in more of an investment manager, real estate operating company model, with a view that the dollars that we invest from our balance sheet would have a much higher return on equity than we were able to ascribe as a publicly traded REIT. And so whereas a publicly traded REIT, if we were investing at 6, 7, maybe 10% returns, for that same investment with third-party capital that promotes along the way and pays us for the value that we create, we're getting 30 to 40% return on equity. And so that was the basis of our thing. The second thing was just we talked about is that you can't ignore, and we couldn't ignore, the amount of capital from around the world that were looking to access good investment opportunities in gateway cities, in Class A properties like we have in New York or in San Francisco, Washington, etc. And I think that the fact that the sales that have been talked about here is a demonstration of what's out there. But that's a trend that we didn't see going away, and we thought was going to pick up momentum, and clearly has picked up momentum along the way. So we've raised $4.5 billion of equity. 95% of it's non-U.S. equity in discretionary funds and separate accounts, pension funds and sovereigns. Most of it have life cycles of 9+ years in terms of the investment and hold period. We now use that to build a $12 billion portfolio. And I think one of the things that's unique in doing this is you can actually raise the appropriate equity for the type of investment that you want to be making. So if you're buying a core asset, there's a group of investors that want to own core New York City office buildings. And so your job is to be able to source and acquire and create the best value you can out of a core New York City office building, understanding the risk-adjusted returns that their expectations are, which is much lower than the type of investor that wants to do ground-up development. And so we have pools and pockets for these different strategies versus, again, as a public company, you're really blending that cost of capital all as one, and you really can't differentiate between each of those different elements. And then finally, what I learned as a public company is it's very hard to buck the trend. When things are going a certain way, when there's an expectation a certain way, people have a view that you need to follow it, and it's hard to be contrarian. So when we came back into the marketplace in 2009, we were buying a lot of debt and partnership interest from public companies at big discounts to replacement costs and big discounts to face value because they were selling to reduce leverage at a point where maybe they should have been buying. But if they were buying, they would have been punished in the marketplace because the market would have been concerned, their stock price would have gone down, their cost of capital would have gone up, and effectively takes them out of business. So you can't really be contrarian, generally speaking, in certain points in public cycles where you can on the private cycle. I don't know if I answered your question, but I got what I want to say.
You didn't.